Hi, my name is Amar. I'm a financial advisor, and this is Kyle. Kyle's a CPA, and today we're going to talk about incentive stock option plans during volatile markets. And we're going to cover a couple key points here, but we really want to give a broad conversation about things you should be considering. So, Kyle, let's start with what are incentive stock options?
So incentive stock options are usually granted to earlier employees at companies. So if you're, usually pre-IPO is typically what I see for incentive stock options. And then there's also non-qualified stock options. So if you have stock options with your company, they're either ISOs, which are the incentive stock options, or NSOs, which are the non-qualified stock options. And kind of generally speaking, for today's purposes, we were thinking, the market's probably looking more towards a downturn, or we're, kind of in correction status.
Yeah.
So in that environment, it can make a lot of sense to, exercise and hold your stock options rather than, just exercise and sell, which is what typically most people do. So.
Yeah, typically people are trying to deleverage the risk associated with their current income coming from the company, their future income coming from the company, and their savings being from the company, right? So
Right.
typically we're saying like, hey, let's take some of the risk off the table and let's diversify. In a volatile environment like this, you could exercise your stock options, so meaning that you own the underlying shares at that point, and then wait to sell them later on when the value is higher. So let's talk a little bit about some of the taxes around that. So how's the capital gains treatment done on that appreciation?
Yeah, and so to exercise and hold your shares, you still have to be somewhat optimistic on the stock price rebounding a little bit, because you could be in a situation where you recognize W-2 income while the stock price is higher, and then get capital loss treatment, which has other restrictions. So typically, if you're in the top tax brackets, your ordinary W-2 income is going to be taxed at 37%. While short-term capital gains are also going to be taxed around the same tax rate. But if you hold for 12 months, you can get long-term capital gain treatment, which will save you about 17% on your taxes if you're in the top tax brackets.
Yeah, so I mean, so there's a lot of good things there, but I guess we should also talk about some of the risk of exercising now, right? Like we may not be at the bottom, right? Like viewers that watch some of our um, investment minutes know that we have fiscal tightening because we haven't had anything come out of Congress in terms of large spending. We have monetary tightening because the Fed's trying to curb inflation, and they're not seeing the rate of change. They're just seeing a exact dollar amount, right, or exact percentage of CPI. And going from 7 to 5, yes, it's a big decrease, but they still see 5%, which is high, and they're continuing to raise rates, specifically when we're going into a slowdown and the consumer is strapped for cash because gas is $1 billion a gallon, right?
So yeah, a couple of bleak factors you
Yeah.
mentioned there.
So what are some of the
It's not
risks of
looking good,
exercising
right?
now? Is that we're probably not at the bottom, right? Like we probably have more headwinds, right? But with oftentimes in our conversations that we've had, it's hard to catch a falling knife and not get hurt. So trying to time it perfectly at the bottom may be very difficult, right? So
Yeah, and so the risk is, you're setting your cost basis at whatever the price is at the exercise date. So let's say it's 100, right? And your strike price is 20. You pay $20 for the share, you pay $80 in the tax, on your W-2. If it goes down from there, you'll have capital losses, and if it goes up from there, you'll have capital gains, which is good. And really, the real risk is, if the share price goes below your strike price, right? And so if you have a fairly low strike price, for example, you're an early adopter of the company, or you've been there for a while, very likely that the stock price is not going to go below the strike price. Not saying it's impossible, but very unlikely. And so if it does go down, you still get to utilize the losses from the date you exercise. It just might not be as tax advantageous.
Yeah.
So it's really the exercise and hold play is really, you have to be somewhat optimistic that the price will go above where it is today.
Yeah, and I think we should be perfectly clear then that the benefit of doing this, right, is gain, right? So you want to talk about that in a little bit here?
Yeah, that, and also capital gains can be offset with other losses, right? And so you can't offset your W-2 income, but you can offset capital gains. So if you have other losers in your portfolio,
that's a good point.
Other losers in your portfolio, you'd rather have capital gains, even though the tax rate is similar. It's better. It's always better to have capital gains instead of W-2 income. So
I would say if you have incentive stock option plans and you're kind of thinking about what you should be doing or how you should be navigating this, you should really reach out to Kyle and I and kind of have the conversation, based off your situation, what makes sense. If you have any questions or comments, please leave it below. Please hit the like button. It helps other people find similar content to this. Thank you.
Thanks, guys.